Good morning on this sunny day, and thank you very much for joining us for our second in our series of Quantuma weekly webinars. I'm going to apologise in advance if there's any technical difficulties. We're all quite new to this new way of communicating. I'll also apologise if any dogs or children appear in the background of anyone's screens, which is always a risk with home broadcasting. For those of you that don't know Quantuma, I'd just like to briefly tell you a little bit about us. We are an advisory firm with offices across the UK, and our primary areas of work are in the insolvency and restructuring, corporate finance, and forensic accounting areas. My name is Gavin Pearson, and I'm a partner in the forensic accounting and expert witness team, and I regularly undertake valuations in that role, and I'm going to be chairing today. I'm joined by my partners at Quantuma, Rob Parry and Jonathan Thornton. Rob's a fellow of the ICAW and a partner in our forensic accounting and expert witness team. He's got over 25 years in valuation, particularly in the context of commercial disputes, shareholder disputes, and merger and acquisition transaction disputes. As well as being an experienced expert witness, Rob also regularly acts as expert determiner, including under the Institute President's Appointment Scheme. John's a partner who heads up the financial due diligence and valuations practice at Quantuma in the corporate finance team. John joined us last year from PwC, and he's got over 25 years of experience working on deals for private equity houses, sovereign wealth funds, corporate and family offices. He also, as well as his due diligence work, gets involved in valuations in the context of mergers and acquisitions. So why did we decide to concentrate on this topic in today's webinar? Well, I'm sure most people who are listening in are very aware of the significant impacts that COVID has had on stock markets around the world, which has led to significant declines in the value of listed companies. There's still large uncertainties around future profits and cash flows, and even the viability of businesses. And within that framework, the real question is, how do you go about valuing a private business with all that uncertainty? So our aim in today's webinar is to cover various topics relating to the valuation of private businesses and shareholdings in the context of the current unprecedented circumstances. It's also important that I stress that whilst this is a somewhat dry and business-orientated webinar, we're only too aware of the human and economic consequences that COVID-19 has had. Most people listening in today will have had some impact, whether the health of them or a relative, whether a financial issue, etc. And we're looking at the fall in value in businesses while remembering the wider context of what this has brought. I should also give a disclaimer that we're going to talk in general terms and are only giving the opinions of the panel. Nothing we say should be construed as investment or professional advice in relation to a specific situation, but obviously if anyone has any specific situations they'd like to discuss, we'd be very happy to engage with those on a professional basis. Last thing I'm going to say, the question and answer function is open, so please do ask questions as we go along. We've received some questions in advance, which we've tried our best to incorporate, but we're very happy to take questions as we go. So I'm going to start with Rob. Rob, as we've said, there's a lot of uncertainty, there's a lot of fluctuation in listed markets. What are the primary issues that are making valuations so difficult at the current time?
Well, thank you, Gavin, and thank you, everybody, for attending. Just a quick note from me, also thank you to our brilliant marketing team, and particularly Vidya and Sharon for putting this together, both at short notice and in these unusual circumstances. I know we have a very large and distinguished and diverse audience of professional advisors, some fellow accountants, some business owners, some bankers, etc. So I hope there's something in this for everyone. It's often said that the sort of definitive way of obtaining a market valuation for a company is to go through a full marketing and sale process. Absent that, transactions in shares in listed companies are sometimes used as analogues for that process to assist in deriving profit multiples when valuing private companies. If we look at the market value of listed companies, there's been substantial volatility at times of crisis. and the resulting historic profit multiples are therefore also volatile. So if the price changes, the underlying multiple as a function of profits or earnings changes. So if those are going to be used to assist in valuing private companies, those private company valuations might also be considered to become volatile. I mean, if we go back to Black Monday in October 1987, which I think is about the year after I started work and sits in my mind quite well, on Black Monday, the FTSE 100 index fell by around 11%, and it fell again on the next day by about 12%. People aren't entirely sure why that was, and there's various explanations put forward. But the thing to perhaps note was it took nearly 2 years for the FTSE to restore to the pre-Black Monday levels. If you look at the more recent times, in mid-February this year, the FTSE index was at around 7,500. As you can see from the graph on the slide, it then fell pretty consistently as concerns re-COVID-19 spread. And on March the 12th, around 10 days before lockdown, it fell by around 11%. So that's about the same as on the infamous Black Monday. I'm not even sure whether that isn't the first time since Black Monday there was a double-digit fall in one day. But then if we roll forward, the index dipped to just under 5,000 on the 23rd of March, which you can see on the graph. Now, on the evening of the 23rd of March, after that fall, the Prime Minister announced the lockdown, and then we see that next day the index actually increased by 9%. And in fact, a couple of days later, on the 26th of March, it reached 16% above the level it had fallen to on the 23rd of March before lockdown. So if I was to take a message from that, it seems that the market viewed that positive action was seen as a better preserver of value than inaction. So taking the action of lockdown gave people some clarity, and the market moved back upwards slightly. It's also important to remember that individual companies will be affected to different degrees. Not even all companies in a sector are affected necessarily the same way. At the time I prepared my notes, the share price for the retailer Frasers Group, which perhaps better known as Sports Direct, has fallen over 50% from its 2020 high. But if you look at the graph, it's now at about the same level it was at last summer. It's lost the subsequent growth. Of course, some bricks and mortar retailers have fared far worse if you compare their position from last summer. Also, if you look at another share, GlaxoSmithKline, Glaxo's share price had fallen to around £13.75 per share on the 23rd of March. And again, at the time of preparing my notes for today, it had increased by around 20% in the last month. So when we've got major stock market indices and well-known listed companies having this degree of variation, where does that leave us with respect to valuing private companies? Listed companies have to have high governance standards and have to make clear public announcements. One view is that private companies ordinarily have less transparency, and that's right in normal circumstances. But when you're dealing with litigation, or when you're in a transaction and you've got the rights to access a data room for financial due diligence, perhaps that disclosure right and due diligence right gives the parties access potentially more detailed information that with proper analysis and proper investigation can help reduce those risks. So I'd say that using that detailed information, it's necessary to give extra focus on and scrutiny of projections, particularly of projected cash flows, and to consider the risks that affect those cash flows, and to try to identify normalized cash flows. Of course, when we talk about normalized future cash flows in valuation, you have to ask the question, what does that mean now for, in this current market? To give a couple of examples, for those of us in office-based businesses, has our model just changed forever? Have we demonstrated, and we're demonstrating as I speak, that agile working can succeed at a level that we never previously foresaw? So how does that change the traditional commercial property cost model? different expectations of working arrangements may introduce greater workforce flexibility. Some of my colleagues are tending to be not working so much during the day due to childcare requirements, but they're working at different hours. So that sort of workforce flexibility may give us a bigger pool of potential employees than there would have been for traditional 9-to-5 office-based roles. And so could this result in further cost savings for service-based industries? And these are just two examples of possible game changers in operational costs. Also, I was reading last week a suggestion that auditors might consider whether companies had the ability to trade with up to 6 months of near zero income and to qualify the audit opinion on a going concern basis if not. So that was the audit opinion, say, you know, we're not sure this company is going to continue to exist. So continuing to exist with zero income for 6 months, I think would be a challenging requirement for many companies. If the company then ended up with a qualified audit opinion because the auditor's view was it couldn't continue with zero income for 6 months, then that could affect banking covenants, it could affect trading contracts and relationships. Strong companies, of course, are also subject to the strength of their supply chain and key customers. So a major failure either upstream or downstream could have a terminal effect on a hitherto profitable and cash generative business. So I'd say the current situation has introduced a potential sword of Damocles to many otherwise sound businesses. To give a comparison, you know, horse racing pays high returns, usually of over 100% of the investment in a few minutes. And the reason it's such a high return is because the likelihood of total loss of investment in the bet. If more companies have total loss of investment as a real downside risk, then the return required for investing in companies will increase. If the required return for investors goes up, then the corollary of that is that the price an investor is willing to pay will go down for the same level of return. And the regular form of cash flow return to an investor is dividends. And of course, we've heard many companies are just suspending dividend payments. So, you know, if there's no dividends being paid, it has to impact on the investment decision and the price that will be paid. One therefore needs to consider how long a nil dividend situation might continue. Also, if preparing a valuation by reference to listed company dividend yields, that's going to be difficult if the listed companies have ceased paying dividends to preserve cash. Some of the increase in share prices in recent years was sometimes attributed to retail investors who weren't getting a decent return in the building society, investing in shares in the expectation of receiving dividends to replace interest on savings. But we're now in a situation where base rate has gone to its, I think, lowest level ever at 0.1%. And also you've got a situation where even major companies are paying potentially low or no dividends. So where will those smaller investors turn to now for return? So it may well be that those companies able to preserve dividends find their share price holds up better or recovers more quickly than others. There is a general presumption that we'll come through this, and I'm very optimistic we will, maybe with the forecast second wave. Obviously, unlike certain people in the news over the last 24 hours, I'm not going to give any medical or virology expert opinion, and my hopeful view might reflect me being an optimist. But I think now we know how quickly a pandemic can change the world economy. Is this going to be considered a systematic risk at a higher level that cannot be, so a systematic risk being a risk that cannot be avoided or diversified? And should that be factored more prominently into all future valuations? So to summarise the answer to your question, Gavin, the factors of much greater short-term volatility, variable volatility within sectors, real risks that previously sound businesses could be wiped out, and lack of dividends acting as a disincentive to investment all make valuations much more challenging.
Thanks very much, Rob. So some very interesting areas there which highlight a lot of the difficulties. It will perhaps be interesting to see if the share prices of disinfectant manufacturers increased or decreased after last night's announcement from the US president. So taking account of all those conceptual difficulties, John, I'm curious what's happening in the M&A market. Have deals come to a halt, or are people still finding a way to do deals, and more importantly, to put a price on those deals?
Well, there has clearly been a hiatus in the deals market for the last month or so. In fact, last week was actually the first week for nearly 20 years where there was no merger or acquisition anywhere in the world valued at more than $1 billion. We've been talking to our PE clients, and most of them have spent the last month or so focusing on their existing portfolios, the investments they've already made, to work out which companies are well placed to survive this, or perhaps are even doing well out of this, and to make sure that the others can get through, have sufficient funds, and have a plan. So they've been sort of more internally focused. But having said that, there are deals still happening. I mean, we still have, as a corporate finance business, we still have a pipeline, albeit considerably smaller than it was a month or so ago. But we do still have deals there which are still moving forward slowly towards completion. There have been deals which have completed in the last month or so. YFM have closed a couple of deals. Foresight have closed a deal. What's also a bit of a noticeable trend is investment from the large Middle Eastern funds into the UK. So notably PIF from Saudi have invested in Carnival, the cruise business, as well as Newcastle United, and the Qataris have bought the Ritz Hotel. So look, many of these deals were probably planned or even signed, some way before this crisis. But I think it gives you a degree of sort of reassurance that they've actually completed and gone through. Moving forward, I have to say, I think the PE firms are pretty well placed. I mean, they have dry powder in the form of money to invest. In fact, they need to do deals. When I was talking to one of them, he basically said, look, we need to do deals or we don't get paid. Debt is still available to fund deals to a lesser extent. You're probably more likely to be able to get debt from a debt fund than a high street bank, and it may be more expensive than it was before. And I think it's going to be easier to do deals, domestic deals, rather than cross-border deals for obvious reasons. In terms of opportunities, I mean, I think the opportunities fall into two main buckets. One is the sort of distressed companies, which, they may have been successful businesses before, but because of this, they're going through a period of distress. Maybe they themselves are fine, but perhaps their parent or the group they're in is distressed. But for whatever reason, those assets are coming onto the market, potentially at attractive prices if you can move fast. And then, of course, there's sectors that are actually doing well. The tech sector in particular, which could offer good opportunities for investment.
That's interesting you say about the tech sector, because obviously you see lots of things online of people wishing they'd invested in Zoom just before this happened. Which other sectors are doing particularly well or badly at the current time, John?
Well, I mean, obviously, most sectors are being very negatively hit. I mean, the big ones that are publicised are hotels, hospitality, leisure, pubs, restaurants, etc. Many of whom are down to virtually zero revenue. Now, a lot of that will come back. Once the lockdown ends, then a lot of these businesses will come back to a degree of normality. Others, I think, are going to take a permanent hit. I think things like the airline industry. I think we keep talking about Zoom. I think a lot of us are going to be using this more, even when the lockdown ends. People aren't going to be jumping on planes so quickly. The same with office space. I don't think there's going to be so much demand for office space in future once now we've all learned that we can actually work quite successfully from home. But yeah, I mean, a lot of sectors are positively impacted. I mean, tech is the big one. I mean, all the Zooms, the Skypes, the remote support, IT support with everyone home working is another sector that's doing very well. I mean, something that's quite dear to my heart. I'm a bit of a fitness fanatic, and ever since my gym closed, which is over a month ago, I've been trying to buy a kettlebell online, and I just cannot do it. Everywhere is sold out. You just cannot get those things. So clearly, the home gym, the providers of that sort of equipment are doing pretty well. In many cases, this is just actually accelerating trends that were in the market already. So, I mean, if we look at another sector, for example, the newspaper media business. So print sales have collapsed because a lot of those were taking place at airports and train stations, which are now kind of closed. But there's been a huge pickup of online reading, including paid subscriptions. So that was a trend that was happening already, but it's been massively accelerated. Other businesses are, the demand is still there, but the route to market has changed. And I was reading an interesting story about the flour sector, and the bulk of their sales were going into the sort of restaurant and catering market, which was selling flour in bulk, 16 kilo bags. Now that market has largely gone, but the domestic market, the retail market, has picked up massively because everyone's baking at home. But that market is for small bags of 2 kilograms. So if you're a flour manufacturer, and there's no shortage of flour, but it's, you need to change your packaging from 16 kilo bags to 2 kilo bags to reflect the changes in the market. And that obviously has a capital cost. And I think the question you're facing is, is this going to last long enough to pay off, the cost of making that investment?
Thanks very much, John. So coming back to you, Rob, from listening to you earlier, you obviously talked about all the difficulties that are presented to trying to value businesses at the current time. Is your view that it's totally impossible to view businesses in any meaningful way at the moment, or is it just difficult?
Well, valuation is normally a subjective opinion anyway, so I don't think you can say that it's strictly impossible. I don't think it can be strictly impossible to give an opinion, even if that opinion is sort of couched in fairly cautious terms. I mean, from my point of view and your point of view and some of the other people attending this webinar who act as expert witnesses, the court needs the best guidance available. Parties engaging experts to undertake an expert determination, they need a determination. In either situation, the answer, it's impossible, isn't really a helpful option. It doesn't help anyone. It might mean that there needs to be a range of valuation opinion given, and I couch that in some cautious terms, and the range might be wider than in more stable times, but the court has to have the best guidance the experts can give. For determinations, a single answer is still needed. You can't go to the parties in a determination and say, well, my determination is the valuation is between 3 million and 10 million. I mean, that just doesn't help the parties. You've got to come up with a figure. I think we may see new valuation techniques evolve, but for now, I think it's necessary to apply the usual principles. Now, those usual principles have been applied to a greater or lesser extent by different people. Many of us will have seen valuations based on just an average or weighted average of historical profits times some sort of profit multiple, with little thought to how representative of the future they could be. And I'd say such an approach will become even less reliable now than it used to be. The emphasis should be, and still needs to be, forward looking, projecting the future cash flows available to the investor might need to be done on more than one scenario. Perhaps you could do a projection of cash flows on a best case, a worst case, and maybe an expected case, and then perhaps taking an average or a weighted average of those cash flows to see what that gives. Also, in the discounted cash flow, the actual discount rate used to arrive at the present value, that again, that might be flexed to recognise the increased risk of the variability of possible outcomes. But as always in a sort of DCF or a discounted cash flow model, it's going to be important not to double count the same risks by taking them into account in both the projected cash flows and in the discount rate. So I think the detail and the quality of the projections that you're working with to underpin the valuation, they're always and always were a key factor in the reliability of the resulting valuation. And I always say when I'm initially talking to clients, try and use more than one valuation approach. Try to triangulate and sense check the results. And I think even more so now than ever, that's going to be valuation. So I suppose to sum up, valuation is going to continue to be subjective, but there's no point of saying it is impossible, because in certain situations, a valuation is required to be given. That includes court judgments and in expert determinations.
Thanks, Rob. I mean, clearly, it's very much the case that one can't just have a range in a lot of situations. And John, presumably that's particularly the case where one's talking about a real deal. It needs to be for an agreed price. So how do you think buyers and sellers will be undertaking the valuation process at this time?
I mean, I agree entirely with everything Rob just said. I mean, look, the key thing is, the first key thing is understanding the actual profitability, the underlying profitability of the business. So, I'm starting to hear this term EBITDA, which is earnings before interest, tax, depreciation, amortization, and the coronavirus. I mean, if you look at things like, LTM, or the last 12 months, which is a common way of looking at profitability, it's now a meaningless number, because effectively you've got 9 months of profits pre-coronavirus, and then a last quarter that's impacted by the coronavirus, and adding those together makes no sense at all. So really analysing the quality of earnings of the business and sort of getting to the bottom of that is key. But value, as Rob said, is driven by the future and future cash flow. So you need to look at, and I could fully understand the difficulty of doing this in the current environment, but you need to look at the different scenarios, and you need to get the kind of weighted, most probable in your view outcome. And I do think, as Rob said, that you need to apply a higher discount rate. In all these kinds of economic crises like this, you end up with a bigger expectation gap between what sellers of businesses think that they might get and what buyers are willing to pay. And that will broaden as a result of this. And the way to bridge that is really through earn-outs, or deferred consideration. So if a vendor thinks that there is still value in the business, that earnings are going to come back, and the buyer has some doubts, then you base an element of the price on the earnings of the business, and that way both sides should be satisfied. I've got to say, ultimately, when it comes to pricing a deal, it all comes down to negotiations between the two parties. And in this situation, as I mentioned earlier, I think really the buyer holds the power in the negotiations. If you've got cash to invest and the seller might need to sell, then the power's with the buyer.
That's interesting, actually, because I recently saw a transaction where about 80% of the consideration was deferred, which ties in with this logic that in the current circumstances, that kind of structure makes a lot of sense. Coming back to you, Rob, in terms of how we think courts might approach valuation at the current time. Now, clearly none of us have a crystal ball as to what the judiciary will do, but in my experience, courts, particularly in smaller matters, often aren't keen on a DCF methodology, which is very widely going to be the primary method for valuing businesses at this time. So Rob, what do you think the courts are going to do in terms of methodology and actually arriving at a figure?
Well, as you say, we can't really answer for the courts, and wouldn't want to be presumptive. I mean, the challenge for the courts, as I've said, is they can't award a range of damages or loss. In most situations, the courts can normally only award a figure, and as I've said earlier, the same applies in expert determinations. So to take an example, if the normal measure of damages in a breach of warranty case is the differential in value of the acquired asset between the value as warranted and the actual value, if the expert or if the court's given a range for both, then this makes the actual range of potential damages even greater, because the difference between the top of the range value as warranted and the bottom of the range of actual value might result in an award several times greater than the comparison being made at the opposite end of the two ranges. And so whilst I expect experts will still provide ranges. I think they'll best assist the court if they can still indicate where in that range they consider the most likely position is, and give their opinion to help the court as to why that's their opinion. Alternatively, I don't know whether we might find the courts coming, away from just giving an award of a figure, because of the degree of uncertainty. And I'm minded, if you take unfair prejudice actions, for example, Section 996 gives the courts very wide powers to make pretty much any award it sees fit. And we saw this in the VB football assets case, which is Blackpool Football Club. Which, whilst as an expert, I generally try and steer away from saying anything about case law. I hopefully you'll forgive me for doing so in this webinar. But in the VB football assets case, the court was provided with two very, very different expert valuations. And the judge found that the degree of uncertainty in valuing the football club, because of the uncertainty as to which league it might be in, meant they couldn't ascribe a value to it. So the court actually made an award based on monies previously paid for shares, monies paid for loans, and then an additional payment for quasi dividends, rather than it being an award based on a valuation of either expert or some sort of compromise between the two. So I think that was a novel approach was applied, and I wonder whether, given the current level of uncertainty, that seems to be a similar situation, that happened in the VB case. So some future awards, might involve novel solutions to achieve the objective of fairness. Maybe there may, potential retention of equity, or even issue of classes of shares with protected rights for existing exiting shareholders. So summary, providing ranges of value is one option for the experts, which is probably a more comfortable position for them, but it won't necessarily help the courts if those ranges are too great. It's possible that, I say novel means or new ways of making awards or orders may have to be considered where a one-off award or a fixed sum can't result in fair resolution.
Thanks, Rob. I think we'll all be watching out for judgments over the coming months to see what happens in practice. I actually had a case that was adjourned a couple of weeks ago, partly because there was so much uncertainty around the valuation, which was central to the case, that things have been put back 6 months, by which point hopefully there'll be some more certainty. So John, I'm asking you now to do a little bit of crystal ball gazing. Are you able to give us some thoughts on whether, in your view, this is likely to be a temporary blip, or do we expect there's going to be quite a lot of volatility in the market for a while to come?
I should probably just first qualify that, Quantuma is not, as you know, in the business of economic forecasting. So this is my personal view, but it is clearly not a temporary blip. I don't think any of us have seen anything like this. At least not according to the Sunday Times since the Great Frost of 1709. The forecast now of a 35% contraction in the second quarter of this year. I was reading this morning, 26 million Americans have now claimed unemployment benefits. That's something like over 1 in 8 workers in the US. So unprecedented levels of economic decline. I think the question really is just the extent of scarring or permanent damage to the economy that's going to come out of this, and that's really critically dependent on how long the lockdown lasts, and if there is a sort of second wave, which all comes down to vaccines and testing and everything else. Look, many sectors are going to be permanently damaged, as I mentioned earlier. Things like the travel sector, I believe. Office sector, but on a more positive note, I do think clearly there will be some recovery, albeit to levels which economic levels which will be lower than we would otherwise have been at, and some sectors will be permanently changed, possibly in a positive way. So, for example, the move online for media, from print onto online, home working rather than being in the office. So so I think that's how I see the future turning out.
Thanks very much, John. We won't hold you to any of those predictions. A slightly different area, but one that was raised by a number of people in their questions prior to today. Obviously, in litigation, one's often having to do a valuation at a particular date. And it's generally the case that one can't use hindsight in undertaking those valuations. So a question first for you, Rob, what do you think one can do in terms of knowing what happened after the event, but you shouldn't really be taking into account in your valuation?
Yeah, thanks. Well, I mean, the litigators in the audience probably, well, they might share my view. Valuation date in shareholder disputes and sometimes in divorce cases is often a battleground, and that might become an even bigger battleground now. As you say, the conventional approach is that events after the valuation date cannot be taken into account. It's the no hindsight convention, as identified in amongst others, the Ageas and QuickFit case. I think exceptions are argued to the no hindsight approach include where there are events shortly after the valuation date where nothing much else has changed. So, for example, a sale of a portion of shares just after the valuation date where there's not really any new financial information, that might give a good indication and might be an exception to the hindsight rule. Equally, financial results that are announced not long after the valuation date, where somebody such as Jonathan on the call here, might have reasonably reliably projected those as following on from due diligence. But I don't think COVID-19 comes into that sort of category. It's such an extreme factor that at, say, December 2019, I'm not sure to what extent anyone considering an acquisition target would have specifically taken into account the risk of what might be considered, a once in a century or, once in a generation occurrence. I think as a claimant or as a petitioner seeking an award of damages based on share value, clearly there's a prospect that they could be bought out or receive an award based on a far more optimistic pre-COVID set of assumptions than has turned out to be the case. For Gavin and me and some of the other people in the audience, most of our valuation work is undertaken some years after the index event. So an event in the first half of 2020 might not result in the need to provide a valuation as at that date until, say, 2022. So, 2-3 years from now, we'll be looking back and trying to put ourselves in the position of an investor now to value a company as at now. Now, in reality, in 2 or 3 years' time, we'll hopefully have a much better idea of how COVID-19 has affected the economy and businesses, and for how long it's affected them. But because of the the potentially dramatic impact on valuation, that's really going to test the no hindsight rule. I think it'll be a challenge for valuers to put themselves back into the mindset we're in now and ignore everything that happens between valuation date and that time in the future when preparing the valuation. I wonder if this is going to give a rise just to a side point, really. Obviously, in family law and divorce cases, the experts are often asked to provide an assessment of liquidity as well as value. So, looking at what's the current liquidity of the company, perhaps to buy its own shares at the value determined. Maybe we'll see that more commonly in commercial dispute cases, such that experts will be instructed to provide a value at the date, but also an opinion on liquidity, the ability of the company to pay. So again, if the ability to pay isn't there because of the cash situation, novel approaches might be needed where there's a big difference between value and the ability to pay. But I suppose, so to summarise, I expect, the normal no hindsight conventions should apply. So I think it's perhaps unlikely, in most cases, the courts will agree in future to specifically discount a pre-January 2020 valuation for the impact of COVID-19. We're putting ourselves thinking 3 years down the line, are the courts going to say, well, at December 19, I'll accept a discount for COVID? Well, I'm not sure they would. And I think maybe this is something John can provide practical comment on from an experience he's had in the past.
Yeah, sure. I mean, actually, the biggest valuation I ever did was exactly this situation. And what had happened was it was valuing a very large multinational conglomerate, which had been set up by the father. The father had died, and the two sons had inherited the business. But they were in a sort of dispute between the two of them, and this business was actually only part of their assets because they had other investments as well. And we were asked to value the business. We undertook the work in 2014, but the valuation date was when the sons inherited the business, which was actually March of 2008, which for those of you who have long memories may recall was just after Bear Stearns had collapsed. But some 6 months before Lehman's collapse. So we kind of, you could tell in March 2008 that there was something of a recession coming, but nobody had any idea how big it was going to be at that point. So when we valued the business, we had to put ourselves in the mindset of March 2008 and disregard the fact that we knew what had happened subsequently economically. And some of the businesses within this group had actually died in the following years, but we had to disregard that, and we had to disregard any actual trading results subsequent to the valuation date. In fact, we weren't even provided with any. But fortunately, what the business was able to provide from their archives was their budgets back in March 2008. So what did they think the future looked like at that point in time? And our valuation had to be done on that basis. So that was a very, very interesting case to have gone through, and I think very useful in the current environment.
Thanks to both of you. I think this is another area that will be fascinating to see what happens, particularly if valuations are based on historical data, but any subsequent payment of damages or payment of divorce case, there just isn't the assets or liquidity there to make them. That's going to give some difficult questions for courts, etc. Another area I think it's going to be interesting in is compulsory purchase, where I do some work, which is where businesses have been extinguished, and ordinarily someone would be entitled to the value of the business at the extinguishment date, but it may be known that actually that business might have ceased trading for a period or potentially altogether. And I think, again, that there's a lot of challenges to come in that area. So John, moving on to a slightly different topic, do you think that there's particular issues in relation to working capital and net debt that need to be considered at the current time in the context of valuation?
Yeah, for sure. I mean, look, there's the same issues, but things have just changed. So, when you're looking at working capital, I think the things to bear in mind are firstly inventory. So, a lot of businesses will have build-ups of inventory. I keep hearing the statistic that there's something like 50 million pints of beer in various shuttered pubs around the country. If you would, in the clothes retail industry, obviously, summer fashion, if that's not sold now, it's not going to sell. So you need to, in looking at any business, you need to look at what the inventory is on the balance sheet and whether it's really saleable, or if you can return it, or really fundamentally what value does it have. The next thing would be receivables, and a lot of businesses will be suffering delays in settlement, to the extent that they're still making sales, of course. So you have to look at the collectability of those receivables and whether there's adequate provisioning against it. On the other side of the balance sheet, I think many businesses will be suffering from stretched creditors. So they may not be paying their suppliers because they don't have the cash coming in themselves to settle those. They may be given actually permission to not pay, and the biggest example there would probably be on the tax side. So the government is granting delays to things like VAT and tax payments, but that liability is still there; it doesn't go away. So if you're buying a business, you're going to inherit these liabilities, which ultimately have to be paid. So it's just a form of debt. So you just have to be very, very careful coming up with what a normalised level of capital, working capital in this situation is. I think the last thing I'd say is really you just need to think about the levels of cash that the business has to hold, going forward, just to sort of tide itself over this sort of lean economic time, and to allow for kind of ramp up as things come back, hopefully, to normal.
Brilliant. Thanks very much, John and Rob. Now we've actually got about 10 or 15 minutes for any questions. So if anyone wants to send some in, there should be a Q&A tab that you can type in on the bottom of your screen. I'm going to start though with a few that were emailed before. We actually had a couple about specific sectors. So Rob, someone's asked about the property sector. Now, obviously we aren't property valuation experts, but it's a sector where there's a lot of uncertainty at the current time, particularly with shops being shut, changes in working patterns, etc. So Rob, have you got any specific thoughts on that sector?
No, I mean, as I said in the sort of the opening comments, really, if we're going to change the way we work, I mean, that's going, at the moment I think you talked about shops closing, and shops closing, is obviously down to the economic viability of the retailer. But also, we've got to talk about offices and the like actually changing, the way people work completely. So viable and prosperous businesses, or businesses that become prosperous again, changing the way they work. So that affects the commercial property sector. I mean, fortunately for you or I, in terms of, asset sort of property-based businesses where the valuation is, can be heavily asset based. It's down to the surveyors to do those valuations. But I think, the same principles apply for them as I've said apply for us. They've got to work on proper principles, looking forward, what are going to be the returns to the investors in the property, and how are those affected by the current, COVID situation.
John, anything to add on that?
No, not really. I mean, clearly the value of anything is the future profits it's going to generate, and I think real estate is something that will take a hit. Particularly with home working on office spaces, and the retail sector and things like malls. If you look at things like residential housing, I think it's very, very hard to know what the value of property is now, because effectively there's almost no transactions happening. So if you were looking to sell your house now, I think that would be very difficult to do, and also very difficult to assess what a likely value would be.
Thank you. And another sector we've been asked about, possibly people in the audience with a bit of a vested interest, is the professional services sector. Obviously, that's a very big sector, and some bits will have benefited and some lost out. But Rob, do you have any thoughts on that?
Well, a few perhaps. I mean, obviously, we're seeing a lot of professional practices in the headlines talking about, partners reducing their profit share. I'm not sure if that's the media actually slightly misreporting, because I think, partners or equity partners in major professional firms, we can decide to perhaps reduce drawings on account of profits, but the profits will be what they will be. I mean, people might say, well, we're looking to take a 20% reduction in profit. Well, they might take a bigger reduction in profit. It's the reduction is in their short-term cash flow as individuals that they're going to draw less from the business. I suppose, when you look at some professional services businesses, IFAs, perhaps, auditors, where there's a recurring income stream, and that usually impacts quite significantly on the valuation of that type of business. To what extent are those recurring income streams going to be affected? If you're an auditor and 10% of your client base fails, well, that's 10% of next year's income that you either need to replace or you've lost it, and that's going to have a fairly serious impact on the valuation of that business.
Thanks, Rob. Taking a slightly different area and tying together a couple of different questions we've had. John, I've had an observation from someone that they've heard from corporate finance advisors that some deals are on hold, but agreed prices are at the moment holding firm. And that person's asked whether they think that buyers will try and chip prices down in due course. And then someone else has also asked whether you've seen evidence of prices that have been previously agreed already being chipped down. So I guess there's two parts to the question. One is, are buyers trying to chip down prices they'd agreed? And secondly, do you think that that will continue further as time goes on?
Look, it's early days to really comment in too much sort of depth, but I think from what I'm seeing and from what I'm hearing, I think that's a pretty accurate description of what's happening. I think a lot of deals, as I said, I mean, some deals are still going forward, albeit perhaps at a slightly slower pace. Some deals definitely have completely gone. But I am hearing that a lot are sort of on hold, including a lot, frankly, of ours. So it's kind of, look, we're still interested, but there's just too much uncertainty and risk at the moment, so let's park it. So I think there's a lot that's on hold, and I can't off the top of my head think of any of chipping that I have seen personally, but it makes complete sense to me. As I was saying earlier, I think the negotiating power is really with the buyer. And if a seller is increasingly desperate perhaps to sell a business, then I think the buyer is in a very strong position to chip down the price.
Thank you. So I think it's probably for both of you is EBITDA as a method of valuation and how that's been affected. We obviously talked about EBITDAC as a new method that can be used, but obviously the whole methodology of identifying maintainable EBITDA and applying a multiple often derived from a comparable transaction in the past is made much more difficult. Do you think that there's still a place for EBITDA multiple valuations, or do you think DCF is very much the way to go now? And let's start with you, Rob.
Thanks, Gavin. Well, as you probably gathered from my answers to your previous questions, I'm saying, very much forward-looking and very much, DCF based ordinarily, because that will enable you to take account of short-term variations. So if we have a situation where there's a complete drop-off of income for let's say 3 months and then a gradual restoration, you can model that in a DCF, which you can't do in a sort of an EV and an enterprise value EBITDA multiple approach. And if you're going to do an EV EBITDA approach now, what is your one-off figure that you take? Or do you say, well, okay, I'll assume perhaps that the EV/EBITDA multiple approach, but then I will knock something off that for what might be considered to be a hit over the next 6, 12, 18 months. So coming up with an EV/EBITDA multiple approach, but then perhaps making a deduction from it to say, well, there's going to be a hit in cash flows, and I'll make a deduction from that valuation. Obviously, you need to derive your EV/EBITDA multiple, and as we've said throughout this, where you've got huge volatility, you're going to have to find a way of working out what a normalized future, EV/EBITDA multiple might look like, or you take a very, very harsh spot view, and you say it's a harsh spot view, based on what it is today, and that's what it is today. But who knows what it might be tomorrow? As we said, there can be 10-20% variation within a couple of days. So my view is better way forward is to look at cash flows going forward, and try and take account of the current situation as best you can in that.
Thanks, Rob. That's very much how I'd see the position as well. John, anything you'd like to add on that?
Look, I agree with Rob 100%. DCF should be the way to go. It should be the main valuation methodology. However, we do like to cross-check things, and if you're doing a multiples cross-check, which I think is sensible, the key thing is to compare apples and apples. So you cannot take a multiple, sort of pre-coronavirus multiple, and apply it to a current level of profitability. So if this continues for a while, then if you've got really live multiples from comparable transactions, then maybe you can use them if they're relevant to you. I mean, at the end of the day, the multiple you're using should be reflective of the rate of growth of that profit number going forward. So if you think that post-lockdown there'll be growth coming back, if you think that that growth is going to be at a similar rate to it was pre-crisis, then there's no reason that you couldn't take that same multiple, but then you need to apply it to a level of profit that sort of makes sense in that context. So as I say, it's all about comparing apples and apples.
Brilliant. I think that summarised things very well. Just one more thing I'm going to cover, just to return to, is that a number of people have asked again about this point of hindsight and how will courts and other bodies react to that. I think Rob has explained well his views on that, and I think all we can really do is wait and see. Or I think our view is that it will be hard for courts to entirely ignore that. I'm afraid that's all we've got time for today, but I'd like to thank everyone very much who's attended, and particularly Rob and John for their very insightful answers. For any questions you feel we haven't answered, then feel free to email them across to us and we'll try and answer them as best we can. Hopefully you found today useful. We're doing our next webinar next Friday, when Jeremy Mindell, who's an expert speaker, and Quantuma partner Chris Newell will be speaking about the economy. So enjoy the rest of your Friday and keep well and keep safe. Thank you very much.